Welcome to our in-depth guide on bonds. If you ever wonder what bonds are, how they work, their different types, features and benefit, you are at the right place, whether you are a beginner or an experienced investor. This video will help you to understand bonds and how they can fit into your financial strategy. So let's get started. Bonds are fixed income securities that represent a loan made by an investor to a borrower, typically a corporation or government. In simple terms, when you buy a bond, you are lending money to an entity in exchange of periodic interest payment and the return of principal amount at maturity. Bonds are a crucial component of financial market, providing a stable investment option compared to stocks. How do bonds work? Bonds operate on a simple principle. An entity issue bonds to raise fund and investor buy these bonds, receiving fixed interest payment known as coupon payments over a set period. At the end of this period, as maturity, the issuer repays the principal amount and bonds are typically considered lower risk investment compared to stocks, so making them a preferred choice for conservative investors. Types of bond. There are various types of bond, each serving different investment needs. So let's explore them. Government bonds, issued by government to fund infrastructure, defense, development projects. Examples include treasury bonds, that is T bonds in US, and government securities G-SECs in India. Corporate bond, issued by companies to raise capital for expansion. These offer high returns but carry slightly more risk than government bonds. Municipal bond, issued by local government for community projects like road and school. Zero coupon bonds. These do not pay periodic interest but are sold at a discount and repaid at full face value at maturity. Convertible bonds can be converted into a specific number of shares by issuing company, offering both fixed income and potential capital aspiration. Inflation-linked bond. These adjust the principal amount based on inflation, protecting investor from rising cost of living. Each type of bond has its own risk and return profile, allowing investor to choose based on their financial goal. Key features of bond. Now let's look into some essential features of bond. Face value, the amount the issuer agrees to repay at maturity. Coupon rate, the fixed interest rate paid periodically to bond holders. Maturity period, the time frame after which the bondholder gets back the principal. Credit rating, bonds are rated by agencies like CRISIL, Moody's and S&P based on the issuer's credit worthiness. High-rated bonds are safer but lower return, while lower-rated bonds offer high returns with increased risk. Liquidity. Some bonds can be traded on secondary markets, providing investor with flexibility to buy or sell before maturity. Benefits of investing in bonds. Bonds offer numerous benefits to investors. Stable income. Regular interest payment provide a predictable income source. Lower risk. Bonds are generally less volatile than stock, making them a safer investment option. Capital preservation. Since bonds return the principal at maturity, they help to preserve your investment capital. Diversification. Adding bonds to a portfolio helps to risk and reduce the portfolio. Tax benefit. Some government and municipal bonds offer tax exemptions, making them attractive for investors. Inflation protection. Certain bonds like inflation-linked bonds adjust their value based on inflation and protecting the purchasing power. So let's know how bonds help investors and the economy. Bonds play a crucial role in the financial ecosystem. For investors, they provide a safer and steady source of income, helping retire, pensions and conservative investors to manage their funds efficiently. For businesses, companies issue bonds to raise capital for expansion, acquisitions and innovation without diluting equity. For government, Bonds help government fund public projects like road, hospitals, infrastructure and boosting economic development. For the economy, a well-functioning bond market leads to economic stability by providing funds to businesses and government at lower cost. While bonds are relatively safer, they do carry some risk. Interest rate risk. If interest rate rise, bond price fall, affecting resale value. Credit risk. If the issuer defaults, investor may not receive interest or principal payment. Inflation risk. Fixed rate bonds may lose value over time if inflation rises faster than the expected. Liquidity risk. Some bonds may not have an active secondary market, making them harder to sell before maturity. Bonds are fundamental investment tool offering safety, income and diversification. Whether you are a conservative investor looking for stability or risk taker seeking strategic investment, bonds can be an essential part of your portfolio. So if you found this video helpful, don't forget to like, share and subscribe for more financial insight. Happy investing!